Welcome back, episode 14 of Making Sense of Your Money. So, as you can imagine, Elizabeth and I lately have had, through our podcasts and through conversations with our clients and prospects, have been talking a lot about volatility in the market, if you haven't guessed. So, in looking at this, the most alarming part for most of our clients and people that we speak to is the volatility in the bond market. Most people have, the stocks, they go up, they go down, they kind of have rode that ride before, but this is a little bit of an unprecedented event that's happening in the bond market. So forever it was thought stocks are volatile. I'm going to stick my money in bonds. They're going to be less volatile. But at this point, that's not really helping. So we've got a lot of questions around that. So Elizabeth, what's going on in the bond market?
Sure, Jeff. Yeah, I mean, we talked about a little bit in our last video, right? Is the old 60/40 portfolio right now, or whatever that allocation is, maybe that you have in a target date fund in your 401k or something like that, is not really doing what it's always done in the past. And like you mentioned, a lot of that is because of this drag, double digit drag that the bond market is having currently year to date. So yeah, we've had a lot of questions just in the last couple of weeks of like, why is this happening, right? What is actually causing these bonds to have this volatility? And there's a lot of factors, but I think one of the easiest examples that I like to give is actually comparing it to a mortgage. So kind of follow me here. If you had, let's say, bought a house 2 years ago, right? I had clients in just last week, and I asked them, they had a rental property, what their mortgage rate was on their rental property. And they said 3.25. They were really proud of that, right? Especially now that interest rates have come up. They were really excited. And I go, how long is your mortgage for? And they said, we took out a 30-year. I go, wow, so 28 more years. And you only have to pay the bank 3.25%. Like, that's pretty great, right? And of course they said, yeah, we're super excited about it. And I said, who is it not great for? And they said, well, the bank. I'm like, right, because they've got to keep you on the books for another 28 years at this low rate, when they can go out and get new people with mortgages at higher rates. And they said, yeah, for sure. So when you own a bond, you are now the banker. And that's what I explained to them. So when you own that bond and you're the banker, you may have some bonds in your portfolio that maybe still have 10 years left of 10, 15, 20 plus years at very low interest rates. And that is what's struggling in those portfolios, is the fact that you have all these bonds with potentially very low interest rates for long tenures left, and you're the banker and you've got to hold those. They're becoming devalued in a sense, right? Nobody wants that. They want to go out and get new bonds at higher interest rates. That is why we've seen kind of this big shift in the interest rate world, and how that's affecting bonds is it all comes down to, what do you own? Are they long-term bonds? Are they, long-term corporate bonds, government bonds, things like that? You're probably seeing a lot of stress on that portfolio, depending on that tenure. If they're shorter term bonds, maybe a floating rate fund, things like that, short-term rates, you probably have seen a very low impact on those portfolios. So that kind of in a nutshell is an easy way to kind of understand how this interest rate environment is affecting your bonds, which, kind of leads us to the next step, Jeff, right? Which is, what do we do? How do we offset this, especially without knowing a crystal ball of when
Right.
things will change?
Right. And, this is certainly, I think everybody knows this. This is certainly not like a Jeff and Elizabeth and our clients problem. This is an industry problem of, what do we do for that short-term money that, especially when you're getting into retirement, of, I need to use this money. I can't see this down double digits. What do we do? So, as if you've spoken with Elizabeth and I in basically the last year, you've heard us talk about this, and we're going to keep talking about it. So what we're doing at this point are using, for that first bucket, which is traditionally mostly bonds, tactical management. Now, what does that mean, and how does that help hedge this risk? So what it means is they're able to move all the way to cash, and a couple of different instruments in between, instead of just saying, hey, we're going to be in high yield bonds and that's it. We're there. Well, some of these portfolios, and especially in our short-term bucket, our bucket one, if you've heard us talk before, we're using two different strategies, but they're all tactical, meaning they can move to treasuries, they can move to ultra short bonds, they can move to cash. So, for example, that portfolio is down not double digits this year. It's down, in the 5 to 5.5% range, depending on when you're watching this video. But today is June 21st, so it's down about 5.5%. So I'm not, and I say this to everybody, and I'm going to say it again today, I'm not expecting you to drive to my house and give me a hug that you're down 5.5% in this bucket. But with the total bond market down over double digits, maybe a hug's acceptable. Just because the thing we're very happy about that spread is because bonds aren't typically going to be, hey, we're going to return 10% in these bonds next year and make this up quickly. So being able to move back and forth and in and out of the market when you're able to see opportunities and move out of the way when the managers think, hey, everything stinks now, we're just going to get out of the way and move to cash and really hedge some of these losses. Now, in definition, tactical managers are here to avoid catastrophic loss. I don't think that the market's at catastrophic loss levels yet, but this is what we're doing. And these are the managers that we're using at this moment to help us offset that risk. So, if you do have questions on this, please feel free. A lot of this isn't investment 101. A lot of this isn't, stuff that you've heard, because we're in this interesting spot in the bond market. So if you have questions, please feel free to reach out to us, set an appointment with our calendar through our Calendly links, and set some time to chat with us. And, if you do know people that are struggling in that first bucket, share this video and just kind of, spread the word of, this is what we're doing. And we think that we're able to really, offset some risk. So again, set an appointment with us through our Calendly link. And as always,
go Bills.